With me today is Craig Kessler, who's the CIO, Chief Investment Officer at Kessler Investment Group, with approximately $325 million under management.
More interested in the analytical side of the industry. The market doesn't care. It's going to do what it's going to do.
And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Craig Kessler, who's the CIO, Chief Investment Officer at Kessler Investment Group, with approximately $325 million under management. Craig, thank you so much for taking the time and welcome to the Smart Money Circle.
Thank you for having me.
So Craig, I always like to begin. Can you please tell us your story and how you got to where you are today?
Sure, I'm happy to. I started in the business right out of college, which takes me back to 1992. And it was after, an academic career that steered me towards more economics than finance. And at the time, during the early 90s, we were still in the throes of a recession. So those of us coming out of liberal arts colleges were kind of taking any job that we could find. And I was fortunate enough to find a job at a time when it was difficult for liberal arts majors. And it was in the field of finance. It was in brokerage. And so at that point, I felt like I was on a path that made sense to me. I had a little bit of time that I spent in the military that I was doing concurrently with the beginning of my professional career. And so all those things kind of lined up in a way that allowed me to progress in the direction of finance in general. So I started on the sales side of the industry. And as time moved on, I became more interested in the analytical side of the industry and still enjoyed my connections with clients and the idea of building a business, and had a long-term view that I would one day start my own firm. But I had a fair amount of, boxes to check before I got to that point. So I continued on my sales career, and every once in a while would kind of deviate into other areas of the industry like wholesaling, marketing. And what that ended up doing was giving me a pretty good flavor for the industry more broadly. It also put me in contact with other entrepreneurs and firms that had started from scratch. So I had a sense of the business models that were out there as a result of some of this work that I was doing on the periphery. And ultimately, I got to a point where I had achieved a little bit of success in building a practice on the sales side, on the traditional brokerage side of the industry, and was asked to start a brokerage operation inside of a small community bank. And so that gave me the opportunity to kind of fast track the idea that I would start my own firm. I'd spent a little bit of time on the banking side, enough to know that smaller banks tended to get gobbled up eventually. Right. And so I felt confident that this endeavor to start the practice inside of a small regional bank, a small community bank, would ultimately lead to an opportunity to exit and use that as a springboard into my own firm. Indeed, that's what happened after a couple of years. And so I was able to launch Kessler Investment Group at the end of 2008, heading into 2009, which, of course, was right in the throes of the great financial crisis. And having that experience leading up to that launch of the firm, I think put me in a pretty good position to understand that that was actually a very opportune time to start an advisory business, because everybody becomes a little bit more concerned with their finances during a tumultuous time like that, and they reach out to professionals. So a lot of folks with maybe a little less experience might have thought, well, that's a horrible time to start a business, right. But it actually works the other way, a little more counterintuitively. So that's kind of what brought me to starting Kessler Investment Group. And that was at a time when I think maybe we had $25 to $35 million under management, with 2 2 staff members, plus myself, and a small business loan, and a lot of anxiety starting the business. And so here we are 15, 16 years later, and we've got a fairly viable, growing business with a total of 8 team members, including myself now.
Wow, I'm going to give you a standing ovation for that one. I can stand up, but I can't. So, number one, thank you for your service. Number two, a lot of overlap. I was a political science major undergrad, and then in grad school, ended up in finance also. So I love the liberal arts connection there. And I love your journey, how you started off in brokerage. I had Series 7 also, so I was in the brokerage side of the 24, all that fun stuff, and then moved to 65. So I love the parallel there, even though this is the first time we're meeting. So, Craig, let's talk about your company, your investment strategy, and anything else you want to share.
Sure. So one of those, or I guess several of the things that I learned on my journey to launching the firm, the business models that I alluded to earlier, were one, to have a multi-strategy approach. One, two, don't spread yourself too thin, and don't bog yourself down with capacity constraints. In other words, a lot of my counterparts in the industry are more financial planning oriented. And that's fairly typical of advisors who have come from my direction of the industry, more the broker and asset allocator, and those that are kind of managers of other managers, if you will, is to go into the financial planning business a little bit more earnestly than the money manager side. So that was deliberate for me to take on a money manager role as opposed to an asset allocator or financial planner role, because of those capacity constraints. When you have financial planning as your focus, then you have to have planners under you to work with clients, and there's some constraints, right? You can only do so many plans in a day, and then you have to add more planners. Whereas a money manager concept, like my firm, is one where we can collect assets, assign them to our strategies, and it's very scalable. And what I found over the years was that clients came to me with one, I guess, question as well as expectation. Craig, we want you to do the best that you can for us. We trust you, and here's our account. And on the brokerage side of the industry, as you well know, that is difficult to do because you're not in the role of a fiduciary. You might have some constraints from your employer that prevent you from making discretionary decisions. And so that was always uncomfortable skin that I was in during those early years of my career. So when I launched the firm, I knew that a fiduciary role was the one that I wanted to take on so that I could answer those questions and deliver on those promises to clients that I could do what I felt was in their best interest, and to consistently deliver my best ideas to them. And I also have a philosophical view that runs maybe a little bit counter to the asset allocators and the financial planners in the world. And that is that while it's a romantic notion that everybody should have their own unique portfolio that is designed for their idiosyncratic role or position in life, it's kind of romantic to think that, wow, somebody created something that's really thoughtful and takes into consideration my risk tolerance and my objectives and when I want to retire and so forth. And there's a lot of truth to that. However, at the end of the day, the market doesn't care. Market doesn't care whether you're 35 or 65. The market doesn't care whether you need to be able to switch to a more bond-oriented portfolio at age 55. It's going to do what it's going to do. And I feel like it's incumbent upon us as the manager to identify where the market is at any given time and navigate those markets. I use a quick example of my father, who's he retired in 1985 at 55 years old. Well, we all remember what interest rates were in 1985. They were 8%, 12%, 15%. And he had a luxury, right? He could just roll right into retirement, lock in a double-digit rate of return with absolutely no risk associated with it. And you know what? 55-year-olds today don't have that luxury. That doesn't happen. That's not available. So what do you do? So those are the types of problems that I like to tackle for clients and setting up this strategy approach where we have effectively we're dealing with the idiosyncrasies of our clients by having a balanced strategy, a rising dividend strategy, a capital growth strategy, and a small cap strategy. I think that covers what everybody needs in their journey toward retirement. Some people want a little more octane in their tank, so we've got small cap. Some people are a little pushed back a little bit on volatility, so we've got balanced, and then we've got our flagships in between. So that's something that I think I learned over the years, or at least took to heart, was the market really doesn't care who you are, where you are in life. And so I felt like it was necessary to construct our business to, accept that truth, and then to be able to deliver on what I feel we do our best, which is individual stock selection, individual bond selection, and connect the client to a strategy that is most suitable for their situation. And from a business model standpoint, it's very effective because that's scalable. We could double or triple our assets under management and really not have to incur a lot of hiring of new personnel. We wouldn't have to change our strategy in any way. It's very scalable in that sense. So that's kind of how I started the business, with that outlook, pulling from those experiences that I had in the developmental stage of my career, as I like to call it.
I love that. That makes perfect sense. So you're moved from not having discretion over the assets. We had to call up Mr. Smith. Can I buy 100 shares of Apple? Hang up the phone. Can I sell, Mr. Jones or Mrs. Whatever it is. Now you have discretion over the account, so you can scale it. And that's your point, which is brilliant, where you're able to create buckets, so to speak, where the market doesn't know you or care about you, but everyone thinks it's all about me. So yes. Wait a minute, hold on a second. It's not all about you. It's about the market and being aligned with what works for you. You might want high octane, dividend, whatever the case may be, and then you allocate accordingly. So would you say, actually, let me ask you the next question, Craig, and then I can ask you about that. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
Sure. So from the client perspective, I see risk in, that risk comes in multiple flavors, right? Yeah. There's volatility risk, there's market risk, there's financial risk. And so we have that conversation with clients so that they understand that risk comes in different forms. And sometimes that risk can be being too conservative, quote unquote, whatever that is, right? Some people's conservative is another person's aggressive. And so what we point out to folks is, you might feel like you have enough to retire on based on current environment, based on prevailing rates, based on the amount that you live on currently, what your expenses are. But life does happen and markets do move. And so it becomes important to understand that inflation risk in retirement is probably your biggest foe. And that's what you have to build into your investment program, is an inflation fighter, because you can be seemingly, or at least in your mind, taking on less risk, but in so doing, creating more risk in another area of not being able to fight inflation. So that tends to be more where I see the folks have a problem dealing with risk or understanding risk, is thinking that, gosh, I've got enough right now. I've got my name the number in the bank, so to speak, and I think I can live off of this, and not take into account the effects of inflation on an ongoing basis. Likewise, I see the opposite too. Sometimes folks come in and they go, well, gosh, I've been doing this on my own for a while on the side, and gosh, I hit a couple of names right. This is easy. I think I'll just go ahead and just allocate, and gosh, the stock market goes up 10% a year over the last 100 years, right? It's like clockwork, and not take into account the stochastics of that volatility. Right. And then they take on too much market risk. So creating that balance is what I find from our clients, and just prospective clients in general, and just my experience over the last 30 plus years, is that people don't necessarily find that balance very well. And one other thing that kind of is not directly related to the question that you asked, but it comes to my mind because it's part of the same conversation I end up having. And that is we have folks that are very good savers and not very good spenders.
Right.
And then we have those that are, shall we say, strong spenders and not very good savers. And I've determined or discovered over time that there's a switch that we have to be able to flip. And you might have spent the first part of your life doing a very good job of saving money. You've been diligent. You have not overspent over the years, and you've developed this nice little nest egg. And then what do you do now? And folks either say, well, I'm going to wait until I'm 70 to draw Social Security because I don't need it right now. And they miss an opportunity to start drawing money because guess what? The government doesn't pay you after you're dead, and they don't pay your heirs, your beneficiaries that you would want to leave your nest egg to either. So get it while you can. One in the hand is worth two in the bush when it comes to Social Security, I believe. So I see people have that mindset and they carry it into retirement, and they don't realize that, gosh, that money that I have in my nest egg at 60 or 62, my body's different at 62 than it is at 82. And I can maybe spend it to enjoy that retirement at 62. But when I'm at 82, maybe I'm not going to take that trip to Switzerland like I would have when I was 62. So having that money available to you to enjoy life, I think, is missed on a lot of folks. And they make a mistake thinking that they've got to keep their risk down. They think they're taking too much risk if they start to spend the money that they've accumulated, not realizing that indeed we can't take it with us. There is a acceleration in our deterioration of quality of life from that point on. And you need to flip that switch from saving to effectively spending. And that's, interestingly, one of the things that I've discovered over the years that I didn't anticipate getting into this business was that people didn't know how to spend money. And then, of course, there's those that are a little too aggressive and they hit age 55 or 60 and they go, oh my gosh, I need to supercharge this. And how am I going to get to a point where I can retire effectively, or am I going to be working until I'm 80? And that's a different problem. But more frequently, I run into and encounter folks that have saved really well, but all of a sudden can't get away from that mindset in a way that they can enjoy their retirement. So those kind of all go together when we have those conversations with clients.
Yeah, that makes perfect sense. So there's multiple types of risk that, if I just to summarize what you said, and to make sure you can adjust when things need to be adjusted. So if you've saved, like the pendulum that swings back and forth, and now it's time for you to enjoy some of the fruits of your labor, so to speak. It's okay to spend, not live in that state of fear or survival mode, and it's okay. And the other side, make sure you don't overspend and run out of money. You did mention something, Craig, and I did want to ask you earlier. So you said create an inflation fighter. How do you do that, or how does someone watching do that?
Well, I think, for one, understand what tools you have at your disposal and how they work, right? So CDs and bonds, most of us are familiar with how they work. They have a set number of years for maturity. They have a guaranteed interest rate that is guaranteed by the issuer, sometimes with a layer of government backing, sometimes without, but always with a guarantee by the issuer. And that's a flat interest rate. And folks might think, wow, I only need to draw 4% off of my investment and I'm earning 6 on this CD or this bond. I'm good to go. And not realize that over time, your costs are going to go up, but that income stays the same. And that crossover point is a very, very painful point for folks to encounter if they haven't built in an inflation hedge. And the way I describe that to clients is to think of how inflation impacts their life and where it impacts them. And usually it impacts them at the grocery store, at the retail store, when purchasing an automobile, and so forth. And if you think that 5 and 10 years from now, you're going to be paying more for eggs, gasoline, automobiles, clothing, if you think that's going to be true, then you need to invest in those areas because they are going to pay you that increase in cost in the form of a dividend hike or in the or increase in principal. So folks think about the income side much more than they do the principal side. And they think, I've got enough income to support my lifestyle, but they don't realize that that income is going to need to go up, and that puts more and more stress on the principal to deliver that income. So you have to have both going up at the same time. And if your principal goes up, it allows for you to draw the same percentage, but since it's on a larger dollar amount, it comes in the form of an increased payment or an increased dividend. And so the way that you accomplish that is by blending in some way, shape, or form. Target allocation is how the term that we use. We focus on a target allocation based on prevailing interest rates and prevailing market conditions to help us with our advice to those clients that are trying to balance between growing their principal and growing their income. Because you don't necessarily want to put everything into growth stocks, even though maybe the return over time is better, because you're going to have to sell those stocks to generate the payments to live on. So a balance between bonds, dividend-paying stocks, and growth stocks, I think, is the most effective way of building your principal over time to be an inflation fighter for your principal, and then also deliver higher dividends and interest payments so that you can take advantage of the payments as well and the stability of principal. So a blending of those two, and therein lies the trick, right? I wish that there was that magic percentage that you needed to allocate, but it goes back to my point of recognizing that the market's going to do what it's going to do. It's incumbent upon us to know how to manage that. And more recently, we've started finding individual bonds to use for our strategies that I haven't seen in a decade, right? Going back to the great financial crisis when interest rates have gotten so low, we had to find proxies and use other tools such as preferred stocks or ETFs that focused on a kind of a diversified portfolio of bonds that maybe were outside of our reach based on the firm's size. So we've been able to move away from that back to our more bread and butter traditional approach to buying individual bonds that are kind of yielding. And I've been telling clients to focus on 5 years at 5%. Once we get to the 5 and 5 for high quality bonds yielding 5% over 5 years, that's kind of a norm, right? That's kind of a period when we can say, all right, now we can release some capital into that space and feel confident that it's going to deliver on what we need that part of the portfolio to deliver, which is a slightly above inflation rate and a high level of protection for the principal. So that's kind of how we focus on addressing the inflation hedge for clients, is to make sure that we've got a little bit of everything. And that's why we have that multiple strategy approach, so that we can have our clients in multiple strategies at the same time to build that target allocation.
No, that makes perfect sense. Thank you for explaining. And I love the inflation fighter title. That's very, very clever. So next question for you, Craig. What are some timeless lessons that you've learned along the way that you'd like to share with the audience?
So this is a industry that gives us an opportunity to look into the lives of all of our clients. And you do well to pay attention to those lessons that you learn looking into other people's lives. I like to say, and this is somewhat tongue-in-cheek, but I hope that nobody's offended by the way that I say this, the two most emotional things in a person's life is sex and money, right? And not necessarily in that order.
Yeah.
And so as a result, we are front and center with the most emotional thing in our clients' lives, which is their nest egg, their money. We see that they allocate it to their kids' education. We see that they build their own nest egg to live on. We see that they make charitable contributions. And so we reap the benefit of seeing the fruits of our labor assist other people in our orbit do what they want to do with their life. what we get in return for that too is a recognition that you have to live life. And so the timeless lessons that I've learned are tied more to living life, appreciating it, and using that nest egg and your ability to generate income, whether that be through W-2 wage or whether it be through 1099 income off of your portfolio, to use that to live life, and that this is not the end all be all. This is a means to an end, and the end being a life well lived. And so that's what we really try to instill in our clients that we interact with is don't let this be the sole focus of your attention in terms of defining who you are. Let it be a means to reach out to the best experiences of your life, and let that be the definition. So this is something that we think we get from our interaction with clients over the years. That's certainly the case with me.
Got it. Makes perfect sense. How about the other side of that? Timeless mistakes.
Maybe a little too much of certain things and not enough of others, right? So the mistakes that I think that people make kind of somewhat goes back to the point that I made earlier, where people are a little too conservative. They don't enjoy life. That's one of them. I think maybe more specifically getting away from the holistic side and focusing some on the technical side. I think that folks make the mistake of diversifying too broadly. I think that that is one of the drawbacks to a multiple mutual fund approach to investing, is you end up spreading your allocation too thinly across the broad market. And while you will never not own the stock that goes up 100%, you will also never not own the stock that drops 50%. And so you end up with that blending. I always encourage investors to seek out managers that they connect with, that have a track record, and focus on the use of either individual stocks or a select group of ETFs to build their portfolio, so that you can capture the best ideas from experienced professionals. And over time, I think that's going to deliver the best results. And there's always the case that's made, especially by the passive investor side of the industry. And trust me, we're all motivated by our own philosophy, right? So the passive side is always going to speak the merits of passive investing, and active is going to do the same thing with theirs. And actually, I've got a comment to make that draws that together here in just a second. But to make that point, the passive side will make a very strong argument that active managers will never outperform the market, that they always fall short of the S&P 500's performance. And there's statistical data to support that. I don't deny that. However, what it doesn't necessarily pick up is the risk-adjusted return, right? So you can have a beta that's a little bit less than the market and have performance that's slightly below the market, and still, I think, have a winning combination. So if you have a beta, which is a measure of risk versus the market, and it starts at 1, so if you have a beta that's point whatever, then you've got a risk level that's below the market. If your beta is 1 point something, then it's above the market, right? And so if you have a portfolio that's consistently, let's say, delivered 95% of the S&P 500, a cynical way to look at that is, well, it never beats the market. I might as well just invest in an index fund. However, if that beta is, let's say, 80.8, then you're getting 95% of the return with only 80% of the risk. And to me, that's a pretty good trade-off to have in your portfolio for individual investors. And oh yeah, by the way, you have a professional that is tied to you and can help guide you through those difficult and sometimes scary periods, where if you might have been left to your own devices in that passive strategy, you might have bailed. You might have at least had a higher anxiety level than you otherwise would if working with a professional. So it's not always a case that you have to outperform the market to reap the rewards of investing, right? There's other components to it, and I think that's a big one. The point that I wanted to come back to real quickly is one of the things that I learned early in my career was, and this is what I was trying to develop as a young professional, was which wagon was I going to hitch my horse to, or maybe which horse was I going to hitch my wagon to, more appropriately, passive or active. As soon as I would feel that the merits of passive investing revealed themselves and defined which direction I needed to go and which horse I needed to hitch my wagon to, the merits of active investing would reveal themselves. And I took a step back and I go, you know what? It's not a question of which one is right. It's a question of when is which one right. And there are times when passive investing is going to outperform, when a broadly growing market, a beta-oriented market that's kind of lifting all boats. Yeah, a more passive approach probably does make some sense, and you can do that with a portfolio manager or an advisor who believes in that philosophy. There are times when a sharp pencil and some experience can help generate some alpha or some value and avoid the broad declines in the market. Right, I'm thinking of 2000 to 2002; those 3 years. Very difficult to be broadly diversified. However, the 3 to 5 years prior to that, you couldn't outperform the market unless you owned the top 10 stocks. So back to back, you had two periods that one really defined passive and the next one really defined active. And kind of just like Democrat and Republican, neither one is right all the time, of course. So you kind of need both. Here in the state of Indiana, I like to say there's Purdue and there's IU, and sometimes Purdue's on the winning end and sometimes IU's on the winning end, but neither one is going anywhere. So the same is true for passive and active investing. There's a reason why those things persist, and I think that understanding that can help lead you to better decisions over time and know when the environment is right for passive and when the environment is right for active.
Yeah, it makes perfect sense. So final question for you, Craig. What is the best piece of advice you'd like to give the audience or your 30-year-old self?
So 30-year-old self is easy and more painful to discuss at the same time. Spending time with family, finding that balance in life, that's key. And knowing that you're going to make mistakes, and that, like the old saying goes, calm seas don't make for a good captain, and embrace those, learn from them, reflect on them. And I think that helps to sharpen the blade and lead you to making better decisions in life. Don't regret those things that you've done. Look forward always and embrace the environment in which you're in and the people that surround you.
Love that. So, Craig, any final thoughts that you'd like to share before we wrap up? Because this has been fantastic.
Yeah, maybe just the outlook thoughts that I have. I think we have here at KIG a process that is based on the notion that markets work in cycles, and those cycles, this goes back to my liberal arts education, which I know you can appreciate. This goes back to the thought that markets are comprised of people, buyer and seller, and emotions run strong when buyer and seller gets together. And so that ends up leading to cyclical nature in the market that's tied to emotion as much as it is tied to business cycle. And so where I think we find ourselves now in the midst of what I like to break out into 17-year cycles is a period that's reminiscent of the 1990s. I think that we're in the early stages of a 1990s type of market, which goes back 17 years from that, 17 years from that, where artificial intelligence, I think, is going to be the driving force in technology. I think we're scratching the surface of it. And I think in the same way that we did with the internet, with the interstate, with the intercontinental railroad, with intercontinental air travel. So these technologies come along every so often that drive market cycles. And I think we're in the midst of one. And I think that we have a 5 to 7 year, maybe 8 year period ahead of us that is going to be very fruitful for listeners who invest in equities with a eye towards their own unique circumstances as it relates to risk. But I think that we're going to see the S&P 500 move substantially higher from here, regardless of the geopolitical situation, and directly specifically tied to the technology that we find at our fingertips. It will end just like it did in 2000. It will end ugly, and just like it did in 2000. But between now and then, I think there's a lot of hay to be rolled. And so I would encourage folks to take a look at the 1990s as kind of a reference point for where we find ourselves today. So that would be some outlook that I would share with everybody.
I love it. Well, Craig, thank you so much for taking the time, and hopefully we'll have you on again soon. This was fantastic.
Look forward to it. Thank you for the opportunity.